We're about to get started, so if everybody could take a seat. There's lots of seats down here. If the room gets too full or you like to work on your iPhone instead of listening to the conference, we're streaming in the room across the way, so there's room for you there. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings. And on behalf of my colleagues here at Brookings and the Washington University's Olin School of Business and the Brandeis International Business School's Rosenberg Institute of Global Finance and the Center for Municipal Finance at the University of Chicago Harris Public Policy School, I'd like to welcome you all to what is the 6th Annual Municipal Finance Conference, the second one that we've had the honor of hosting here at Brookings. As many of you know, the mission of this conference is to bring together scholars and market practitioners and public officials, both on the issuer and the regulatory side, to improve the quality of research in municipal capital markets and state and local fiscal policies in general, and to ultimately improve the quality of public policy. The goal of all our efforts ought to be to make America a better place and make it easier for our state and local governments to function on the behalf of their constituents. I just want to explain to you a little bit about the logistics of today. We're going to start, and I'll introduce the panel in a moment, the speaker in a moment. We're going to start in this room. We'll have a break at 2:30, and then we'll divide into two sessions. We've kind of conceived them roughly, one more on state and local fiscal and economic issues and one on more muni capital issues. In this room, the Falk Auditorium, we'll have the papers by Boyd and Yin, Shoag and Farrell and Boylan on pension plans and the impact of the Voting Rights Act on municipal reform and pensions. In the Sol Zilka room, which is just on the other side of the coffee pots there, we'll have a session on Andy Calate's paper on a yield curve and Dario Sestow's paper on negotiated sales restrictions of school district bonds and natural experiment. And Komla of SUNY Binghamton, you'll have to get him to pronounce the last name, on some of the impact of regulatory disclosure interventions in the secondary market. At the end of the breakout sessions, which should be around 4:45, we're going to move to the Capitol Hilton, which is a few blocks away. We'll have drinks for about an hour and 15 minutes, and then we'll convene for dinner at 6:30. If you don't feel like walking in their tropical conditions in Washington, we're going to have a van at the front door here that'll take you to the hotel, and it'll make multiple trips. The same thing will happen in reverse in the morning. We're very pleased tonight at dinner that after we have drinks and our first and second courses, we'll be joined by Mayor Kasim Reed of Atlanta. More on that later. My colleagues from Brookings around the registration desk, or you'll get to know who they are, can help you with any logistical issues. There are instructions in your folder about using the internet, the Wi-Fi. The bathrooms are right back there, and our maintenance staff would greatly appreciate it if you have a cup of coffee or papers at your seat, that you put them in the garbage cans when you leave. We decided not to print out copies of the papers. It just seems inefficient. They're all posted online already, and if you need a copy for any particular reason for a discussion or something, just let us know and we can put that out. The entire conference is on the record. This session this morning, the paper and the panel discussion will be live streamed, as will the panel at the end of the program tomorrow on public investment. We will be videoing the conversation with Kasim Reed tonight at the Capitol Hilton. We'll put that up sometime later. It's not practical to live stream off-site. It's a big group, which is very heartening. It sometimes makes it hard to have a dialogue. But we're going to allow time for questions at every session, and we really encourage you to participate, because one of the points of this conference is to bring together people who have different perspectives on the same thing, whether it's from the regulatory side, the issuer side, the market side, or the investor side, or the academic side. And so, as much as possible, we hope you'll all participate. I think it was a great, really appreciate that Dan Bergstresser of Brandeis and Martin Luby of the UT Austin agreed to pull together an enormous amount of data to shed some light on how the municipal capital markets have changed since the Great Recession, which it's been almost a decade now since the beginning of the financial crisis. It seems almost like yesterday in some respects. So what's going to happen is Dan is going to present. He has some slides, which will be on our website. And then Rich Reifel from WashU will come up and introduce a panel. They'll be up here to discuss this issue, which is really pretty wide-ranging. Dan and Martin have pulled together an enormous amount of data, and we're going to look for a good way to make that publicly available in case other people are interested in doing research on the questions that they raise in their paper. They've really, I think, just skimmed the surface, but it's an incredibly important surface to skim. So with that, I turn the mic over to Dan Bergstresser.
All right, can you guys hear me in the back? Can you guys hear me okay? So first of all, I want to say sincere thanks to Brookings, to Brandeis, and to UT for providing the support that was involved in acquiring some of the data for this paper. And thanks to the MSRB, which provided the trading data that we have. And this work is co-authored with Marty Luby, who's a professor at the University of Texas. Our goal here is to be systematic about thinking about the changes that have happened in the muni market, both in the primary market and the secondary market over the period between 2000 and 2016. So the period before the crisis, the period during the crisis, and the recovery from the crisis, which continues. The tables that we have, it's actually kind of a subset of the total number of tables that we've created. They're up on the website. So as I go through the presentation, you might see a table number if you're following along in the table deck that's on the website. That is a pointer to the table number in that presentation. We're going to focus on 10 things. So the sources of the data are Mergent, which is a provider of fixed income attributes and characteristics, recently acquired by the London Stock Exchange, the MSRB, and also for some deep analysis of Texas, we got data from the Texas Bond Review Board. I will say that one thing that Marty and I did a lot of work, we did some stuff that is really smart, we did some stuff that is really stupid. The really smart thing that we did, the way in which we dove deep, was if you go to the Mergent data, the identification of underwriters, the identification of financial advisors is good but messy, right? In the sense that they will, they'll have 8 different things that they call JP Morgan or 8 different things that they call sort of the same bank. And so we did a lot of work to create consistent mappings that allow us to identify consistently who the underwriters are, who the financial advisors are. And that's something that we want to share with the community because I think as you do research, it's important to have access to high quality. And certainly if you find errors in what we've done, then let us know. This is a process that we hope will be iterative. The thing that we've done that I think where we're not at the frontier of what you can do scientifically is we're going to do some very simple comparisons. Right, we're going to compare measures of spread in the negotiated competitive underwritings. If you want to assign a causal interpretation to the differences that you find there, you'd really want to do something clinical, right? You want to do a controlled, double-blind clinical trial. We're very humble about what we're doing in this analysis. We've got the data right, but in terms of the actual analysis, we're showing correlations, and we're not necessarily taking a causal interpretation to everything that we're finding. Right. So the first thing that we want to show, and the first thing we want to express is. A lot of academics, at least, don't appreciate the extent to which the market has changed since the crisis in terms of the issuance. The issuance recently has been tilting way in the direction of refunding existing bond issues. The new issue category is one that is declining in significance in a way that is really remarkable. The decline in sort of new money bond issuance has outpaced the decline in infrastructure investment. Right? If you look at how fast infrastructure investment is declining, but it's declining more slowly than the new money bond issuance. What's going on is that you're seeing increasing reliance on bank finance. Going forward, you're going to see increasing reliance on P3s, right? We think that this is creating conditions that it's worth being aware of, right? In the sense that we're not confident that there's total transparency about the risks that issuers are taking on when it comes to borrowing directly from banks, when it comes to P3s. And so one thing is, as people who study the municipal bond market, one emerging risk that we see in that market that in some ways mirrors the risks that built up leading up to the financial crisis, where you have risks in the context of bond issues, but it's the combination of variable rate issuance combined with swaps that created the potential for surprising realizations of existing risks. We think that there's also cause for concern now in terms of the increasing reliance on bank finance and the potential that issuers are taking risks in terms of acceleration, in terms of the terms of those bank financings that are not appreciated. If you look at the type of coupon, this is the dark blue is fixed rate, the light blue is variable rate. You see the kind of the peak in the variable rate market, and what we should say is that this was by and large variable rate bond issuance that was happening in the context of a synthetic fixed structure. So this is not actually taking a net variable rate exposure. This is a variable rate, an auction rate security combined with a swap. So the net exposure was, in principle, the net exposure was a fixed rate exposure, with some basis risk, which had the potential to materialize. Right. So this is the way in which the market has changed. You see the collapse in variable rate issuance. The structures, the variable rate structures of the period between 2005 and 2007. Embedded a variety of risks for the issuers. And we think the MSRB is on top of this, but this is something that as professors, we feel like the entire community needs to be aggressive about making sure that the principles of transparency and disclosure are articulated again and again. So when it comes to getting into the nuts and bolts of the structure, I think this is an important graph because it highlights the way in which the market has really changed. If you look at the weighted average maturity of bond issuance 2000 to 2016, it's gone down to 13 and a half years is the weighted average maturity. What that means, given that most of the issuance, even when you were seeing a lot of variable rate issuance, was synthetic fixed, what that means is that if we do transition to a higher interest rate environment, the pace at which that gets passed through to budgets will be more rapid than it would have been if you had a maturity structure with sort of longer maturities. Right, now we start getting into the nuts and bolts of the primary market. What we're doing here is we're combining data on the bond characteristics with data on the trading of the bond in the first 30 days post-issuance. So we're looking specifically at a measure of the efficiency with which the primary market works, which is the spread between the price realized by the issuer and the price at which the bonds are sold to the customers in the first 30 days post-issuance. Two things I think are important to see in this chart. This is something that academics have focused on quite a lot, this measure of the efficiency with which the primary market works. Right? So if you see an issuer getting 95 cents, or if you see an issuer getting $1 for a bond that a customer turns around and buys for $1.10 20 days later, certainly that could reflect the cost of intermediation, but issuers have some justification for feeling that that's potentially a rent that is being captured by the dealer community. What you see when you look at the numbers, when you look at that spread, is that it really matters a lot whether you weight by the bond issued or you weight by the dollar of issuance, right? So the dark line here is the average spread in the primary market weighted by the dollar amount issued, and the light blue is weighted by the bond, right? So that the average bond at the bottom, can you guys see the bottom row? Is it blocked by the, I'll just push the tables over. Actually on the bottom row, there you go. Right, okay. Bottom row, you see not weighted by bond size, it's just sort of weighted by bond. You see that the average spread in the primary market is in the neighborhood of 18 basis points, 20 basis points during the crisis, which we define as 2008 to 2010. That's not like a scientific definition, but we separately identify 2008 to 2010. And the thing that really jumps out about that 2008 to 2010 period is that during that period, if you weight by the size of the bond, actually the spreads are higher, right? So if you look, most of the time, the analysis that has been done of the spreads in the primary market has kind of looked at the average bond, where the spreads are pretty high. We think there is some utility to looking at the average dollar of issuance, which tells you sort of, what is the dollar amount of spread in the, whether it's compensation for the real cost of underwriting, whatever that is. We think it's important to focus on dollar amounts. And the dollar amounts are actually much lower than you would think, just from looking at the average bond. Right? The larger bonds are from this analysis cheaper to intermediate, except during the crisis, where the cost of the larger bonds went up. And so that's a pattern that is I think worth knowing about. 2009, 2010 is pretty unusual. The larger bonds appear to have more primary market underwriting. Right? So here's where we're we're saying, I think appropriately, academic research has been positively influenced by the need to really nail down causation. What actually causes a phenomenon. We're just saying, with this graph, we're just saying, damn the torpedoes, just straight ahead, just simple means, right? What is the average spread competitive sale process? What is the average spread negotiated? And so we cannot assign a causal interpretation to this. This is just a correlation. But what you see is that the bonds that are sold through the competitive process, the simple average spread in the primary market is about half, depending on the time period, what you see in the negotiated bonds that are sold through the negotiated process. Right? And this is, if you kind of look at the spread over time between the spread in the spread, right? So comparing the spread, this is the differential between the spread and the bonds sold through the negotiated process and the competitive. You see it kind of peaks during the crisis and then comes back down. Right? Then we start trying to really kind of make enemies here. We actually cut it by the size of the underwriter, right? And in principle, you could sort of boil it down to the specific identity of the underwriter if you wanted, but we didn't want to make enemies who are that specific. So we just broke it into small underwriter and large underwriter, right? And again, not assigning a causal interpretation. Like this is just a simple correlation. And if you look at the spreads, there's a little bit of a wedge where the bonds that are underwritten by large underwriters, it looks like there's a lower spread than the bonds that are underwritten by smaller underwriters. And we can do similar analysis that we do in the tables. Don't have slides in the slide deck, but you can look by the size of the financial advisor. Are you using a large financial advisor or a small financial advisor? We also, for the bonds that are issued in Texas, the Texas Bond Review Board collects information on the explicit costs of issuance. And you can look at the relationship between the explicit costs of issuance and then this implicit cost coming from the spread. And it looks like the bonds where the explicit costs are higher, you actually see somewhat lower spreads. Right? So if you pay a lot in terms of explicit costs in the context of underwriting, those bond issues are associated with with smaller spreads in the primary market. And so this is by underwriter size. Kind of an interesting phenomenon. We again, this is all correlations, but we do if you compare the two rows, there's kind of a gross differential in the spread between the small underwriter underwritten bonds and the large underwriter underwritten bonds. And the top line is just the gross differential in the spreads. Then we try to control for the characteristics of the bond. We say, what's the purpose of the bond? What's the size of the bond? A variety of different characteristics. And when you control for those characteristics, instead of getting smaller, the differential actually gets bigger. Right? So it looks like controlling for the characteristics of the bond actually appears to make the spread between the spread in the primary market look bigger. Okay, so what's the upshot? it appears that the bonds that are underwritten via smaller underwriters, you see a greater spread, and the relative underpricing gets greater when you control for the bond's characteristics. Another phenomenon that we don't think, Eric Seary did a really good report for the MSRB a couple of years ago, where he focused on, any pattern of sale to a dealer followed by a sale back to a customer. It's really interesting to track what's going on with the inter-dealer trades, right, in that process. If you think of the entire intermediation, I'm an issuer, I sell a bond to an underwriter. That underwriter may sell a bond to a different underwriter, to a different dealer. Maybe it goes to a different dealer, and then it ends up in the hands of a final customer. One thing that Marty and I are finding as we kind of torture the data is that if you look, and the blue line is the mean, right? So walk that across to the right-hand side. The number of inter-dealer trades in the context of this primary market went way up between 2000 and 2009. And you're seeing the bonds go through more hands in the primary market. Then it kind of comes down after the financial crisis. You see the spike in the financial crisis where between 2007 and 2008, all of a sudden, underwriting a bond is associated with just many more inter-dealer trades. There's something that's changing about the way in which the market is working during the crisis, where you're seeing sort of a more rapid intermediation or a more intricate intermediation, right? And then it eases off, and since it's come back, it appears to, you never want to say anything's permanent, but there appears to have been kind of a regime change where the number of trades that you're seeing in the context of a new issuance, it's a more intricate, more involved process, potentially because of a reduction in the cost of doing each individual trade. Right? So what's the upshot? There seems to be sort of a stable change in the regime where the average number of interdealer trades in the primary market has gone from around 2 to around 4. Right? Now we start looking at transactions costs in the secondary market. So these are seasoned bonds. And this analysis follows pretty closely the work that Eric Seary has done in his report for the MSRB. Again, trying to think very, very hard about identifying packages of trades in the MSRB data that add up to effectively one transaction, right? So if you see a dealer buy $1 million worth of bonds from a customer, and then you see like 8 interdealer trades where the bonds are sort of going from dealer to dealer, and then it gets broken up into 4 sales to customer, each worth $250,000. We bundle that together effectively into one round trip transaction. There is the phenomenon of taking, buying $1 million and then breaking it up into, a bunch of different sort of smaller blocks is, in some sense, the exercise of an option, because it's hard to kind of put that back together. And once you have a small block, it's potentially, as you'll see, it's more expensive to trade that small block. But this is what we see in the spread in the secondary market trades. And what you notice, the blue line is for small trades, right? We define as less than $1 million. Right? The light blue line is for large trades, which we define as trades where the par value, it's a par value that we're using to cut it, greater than $1 million. The price of transacting in terms of, in small transactions is, it comes down, right, around the time that you have a real-time reporting, and it goes back up during the financial crisis. So that's a 2% is the average round-trip transaction, average transaction cost. And then it's come way down. It's about half what it was in 2000. If you compare the cost of doing a small bond trade today, it's half what it was in 2000. If you look at the large transactions, right, the average spread on the large transactions between 2000 and 2007 was less than 10 basis points in that period, and now it's almost 20 basis points. And so if you ask the question, is it more or less expensive to transact today in a secondary market trade in the muni market than it was 10 years ago? It depends really very much on whether you're a large trader or a small trader. For the small traders, it's become less expensive. For the large traders, it's become more expensive. And the last piece of analysis that I'll talk about before ceding to the discussants, this is the upshot. Large trades become more expensive 2007 to 2009, and it's not a blip. Like a lot of changes that you see during the crisis, you see that sort of something strange happened during the crisis and then we go back to normal. That's not the case here. It seems to be a permanent regime change, right? This is the number of interdealer trades, right, in the context of any, the average secondary market transaction. And you're seeing the same phenomenon that dealer buys from a customer, sells back to a customer. For the average trade in 2000, you saw 0.39 interdealer trades in the context of that intermediation. Now it's almost 1.4. So you're seeing a lot more activity for the same final customer solution, which is buying a bond and selling it back to a customer. You're seeing a lot more activity. And that could potentially reflect the fact that it's cheaper to do the activity. Like anytime something gets cheaper to do, you're going to see a little bit more of it. But you are seeing this phenomenon that the interdealer market is becoming more active, at least by this measure. We think this is going to matter because as we transition to a regime where markups are disclosed to customers, one of the phenomena that is going to be important to pay attention to is what are the details of how the markup, how and when the markup has to get disclosed, right? So if I buy, if Colin sells me $1 million worth of bonds and I turn around and sell them immediately to Marty, like that's very clearly something where I would, based on my understanding of how the rulemaking will work, I would have to report that the markup will be transparent. But if I pass it around, from dealer to dealer for a while, potentially over, a couple of days, I might have accomplished the same underlying economic objective, but you can imagine that being handled differently in terms of reporting the markup to the clients, and so that's something to pay attention to. So, if you take away if you take away 10 things from our analysis, the market is changing. I think a key way in which the market has changed, and this is something that I think George Friedlander has highlighted. People are aware of this. Is that we have to maintain our understanding of the distinction between financing and funding, right? So the decline in new money bond issuance is much more rapid than the decline in infrastructure spending. So the money is coming from somewhere. It's banks. It will be P3s. That will have implications for the credit experience of bond investors. Like I really want to know, what are the terms of the bank loans that issuers are taking on, or the way in which risk is shared in the context of a P3 that they're doing. And so we think it's a priority for the academic community to maintain the focus on transparency in this changing world. Issuance and trading costs increase in the 2007 to 2009 period. The extent to which it's kind of gone back depends on exactly how you slice the data. When it comes to large trades, those appear now to have become permanently more expensive. The small trades are now cheaper than they were. In both cases, trading is becoming, and this is not a scientific term, but trading is kind of becoming more intricate. Like you're seeing serving the customers in the same way is just involving a lot more steps. You're seeing the bonds pass through more hands, and that's going to have implications for how the regulators think about disclosing, among other things, disclosing markup on transactions. So it's worth keeping an eye on. So thanks very much for your attention. And Rich, would you like me to just sit here? All right.
Thanks, Dan. Again, I'm Rich Reifel. I'm with Washington University in St. Louis, one of the conference co-chairs. I want to invite the panel one by one to come on up, starting first with Marty Luby from UT Austin, who is Dan's co-author on this. Natalie will rebut. Marty will now disagree with everything Dan said. Natalie Cohen from Wells Fargo. Brad Wendt from Charles River Associates, and Colin McNaught from BondLink. All of their resumes are in your packets, so I'm going to forego any more in-depth introduction of them. So Dan and Marty accepted our challenge to put together some great data that we could all chew on, and all of these slides, as you know, all of their charts are on the conference website, and this panel's task is to try to distill some of that information down from 27 charts to the 10 themes that Dan talked about to 3 main themes that we're going to discuss up here. And then we'll open it to some questions from the audience. We are on a bit of a time constraint, so we'll be somewhat brief in touching each of these points. Before we start, I wanted to just make a few observations, because I think this is the first time that any sort of wide-ranging data analysis has been done before and after the crisis. So I think this is going to be great fodder for academics moving forward. But I had a number of observations that I just sort of made anecdotally before and after, and I wanted to toss those into the mix with no backing other than my own observations and opinion. So I think we're at a bit of an inflection point now that we're almost fully 10 years after the crisis. So we had a period of very low interest rates. Those are now beginning to change. We had a period of enhanced regulation, perhaps with the new administration and some revisions to the regulatory environment. That's going to change. We had a severe reduction in the use of bond insurance. That's beginning to change. We had a lot of private placements and a lot of private transactions being done. I think now, as Dan just pointed out, as some of the risks in those transactions are being known, perhaps that trend is going to reverse itself. We had a period of very high innovation before the crisis. A lot of the synthetic debt that Dan referenced was an example of that. Then we had that innovation in the headlines, so that lowered innovation. And I think as memories recede and risk gets repriced, we might see more innovation. That coupled with some of the potential administrative proposals around infrastructure and P3 and that sort of thing might encourage some more innovation. So I'm looking forward to the discussion to see how perhaps the data could be used to inform policy moving forward as we are at this inflection point. So. All right, so the first theme that we wanted to talk about is we had this great data on coupon type, fixed versus floating, and all of our panelists have some pretty strong, informed views on why that might be the case. So I'll just start perhaps with Colin.
On why that's the case, or the implications? On
the implications. And yeah.
Okay, sorry.
And do you think, is that likely to continue given that we're in a rising interest rate environment?
Yeah, on the one hand, it's a good sign, right? You're seeing that governments are taking advantage of shorter, lower long-term interest rates. They're issuing more fixed-rate bonds than maybe they normally would. They're saving capacity to issue variable rates when the yield curve steepens. That's a really good thing as well. I think the concern would be if issuers are not focused across the balance sheet and looking at interest rate risk that is on the investment side as well as in their pension funds. So debt is not managed or issued in a vacuum. It's one single government. I was with the state of Massachusetts. I was issuing in my silo, but we had to manage billions of dollars in short-term cash and $50 billion in pension assets. So every decision I made in terms of interest rate risk had some sort of risk impact across the balance sheet. And while I thought issuing fixed-rate bonds was conservative across the balance sheet, that was the exact opposite. So my observation is a lot of fixed-rate issuance. It may be a good thing on the one hand if governments are not realizing that they are positioning their balance sheet in a very, very specific way. Their balance sheets will not do well in a declining interest rate environment if everything is fixed on the debt side. And that's a concern. That's a concern. I think from my own practical experience, I was a little bit of a variable rate junkie. I liked variable rate. I liked floating rate, particularly plain vanilla structures. I think Dan and Marty pointed out that some really obtuse and opaque structures were used in the past and used heavily, whether it's auction rate securities or VRDBs or swaps. If those have gone away, it's a very good thing. If they're being replaced by something else, it's in the market's interest to discover what those new structures are. Are they bank loans? Are they direct placement? But going back to the initial point, fixed versus floating, there's a lot of capacity in the market to do more floating rate. There's so much supply coming on the long end in the form of fixed rate bonds that will have an impact or is having an impact on prices for issuers.
I think that's a topic that's been the case on the federal level as well of late. Brad, do you want to add to that?
Certainly. I think it's probably time that municipal issuers jump back in the pond, and we were all around for the carnage in the LOC and the Dutch auction market, which correctly scared the heck out of everyone. It would, you know, our left bookend is the fiscal crisis. But after seeing some of these excellent slides, I said, well, that's strange. I'm not sure if the slide was up there, but as recently as last year, I think the ratio was 90 to 10 in terms of fixed rate bonds versus floaters. And I said, well, let's just take a look at where the SIFMA index traded for the last decade. And you don't have to squint. It was certainly under 50 basis points, 0.5%. So as you've just pointed out, if you're not taking advantage of that, and for your operating cash from a policy perspective, you're earning 0.5% or 0.75%, you are just grossly mismatched. So if we try to say, why is this happening? Everyone still has the scars, the bruises of the failed auctions and everything else. The LOCs are, once again, banks are healthy. They're back in the marketplace, as just pointed out. And my comment is, I think, from a policy perspective, issuers really have to take a look at their fixed and floating mix, because when you can start paying all in at 0.5% for your capital, certainly you don't want your whole portfolio in that realm, but certainly some percentages, more than 10% is very reasonable, in my opinion.
Natalie?
So I think the mission now to take this amazing data that you've put out there is to try to separate what's, as you put it, Dan, a blip versus what's an enduring trend. And in terms of the variable rate, I think a lot of, at one point, the market, you're touching on the apex between regulation of banks, regulation of the bond insurance business, and regulation of the securities market. And what was happening was there was this huge issuance taking advantage of the curve of tender option bonds. And they were supported by bond insurance on the long end, and therefore cost less capital for banks to use the bond insurance and create these types of structures. So I think the question is, the unwind of that obviously created a big anomaly, which was throwing a lot of long-dated paper on the market, and you can chart sort of what happened during that. As you have, you can chart the process of what happened during that time period with pricing on the longer dated paper. And so, you know, is that going to reoccur? I don't think so. It may take a different shape. There may be some other product. But I think that as one of the other speakers pointed out, most of us, including issuers, have been extremely chastened by what happened then. So I think that's really the effort all across the board, understanding what in this data is a single anomaly. We also, and we'll probably get to this, but if you look through the charts, that 09-10 period was Build America bonds. Build America bonds were non-callable, long-dated, and what that did was it squeezed the tax-exempt market into the shorter end. Sorry, I always talk with my hands and I tend to hit the microphone. We're short-dated on the tax-exempt side, and so I think that if you look at your charts during those time periods, that might get you to a little bit of the why things gapped out at that point. So again, BAB's non-callable, long-dated, and also large in size to attract corporate investors because they were taxable. So to attract and give the impression that there was greater liquidity in those instruments, they were larger deals. So I think you had a distortion at that point in time. Again, is the question longer versus a long blip, or is that a one-time blip that we may not see again?
I'm going to move on to our second topic, a favorite of mine, underpricing as a, yeah, Dan?
My microphone, can I say one?
Yeah, please.
I want to just reinforce what Colin said. You know, if you look at any issuer that's making a decision about what mix of variable rate and fixed rate debt to have, that risk exposure is dwarfed in a long run sense by the exposure in their pension plan. It's just orders of magnitude different. Now it may not. You know, you can defer the accounting may make it a context where you can defer the recognition of losses, but the reality is there. I think the other thing that strikes me is that if I'm an investor in the municipal bond market, it seems to me like the biggest risk that I face is the pension risk. I mean, depending on where you're investing in it. And it seems like as a community getting more aggressive about influencing the asset allocation of pension plans is not a totally crazy thing to contemplate, because you look at a pension plan, it's almost like a gambler at the table. Like there's somebody sitting there at the table and they're gambling with resources. You know, how that works is gonna affect whether or not the resources are there to pay back the municipal bonds. And I think as a community, the bond community, rather than sort of parachuting in once the default has happened or once the crisis has hit, getting more aggressive about looking 15 years out, looking 20 years out and saying, hey, what place is okay if they step back from the table today? Right? What are the places that if they step back from the table and tilt their asset allocation in a way that means, you know, it might hurt them right today, but it means we get paid. That's not a crazy thing to think about coming together to do as a community.
If I could just make one comment related to Brad's comment about getting back into the water with variable rate debt. I think it's incumbent on the academic community to chime in on this issue, which is that if issuers had issued a lot more naked variable rate debt in the period, you know, before the crisis and even after, there's significant savings, and you would have realized significant savings over the last 15 years. A lot of the debate, a lot of the discussion is anecdotal. So I think it'd be a worthwhile endeavor for academics to look back and show, you know, some kind of non-biased analytical, and offer some non-biased analytical analyses to show what the opportunity cost has been not to have more variable rate exposure in your portfolios.
Speaking of a topic that would make a lot of enemies. So in the interest of time, this may be our second one. We may then open it to the audience, so I'm going to reserve the right to call an audible on that. But underpricing is a favorite topic of mine because I was an investment banker and never underpriced an issue. So I was interested to see some of the data. I'm curious what the panelists think about that. Colin, you want to start? Yeah. You were an issuer, always right on market.
Yeah, not sure why I'm going first all the time.
You're next to me.
So really interesting data. I mean, it's not easy to interpret. Some uptick in prices are probably expected or inevitable, but how much is sort of due to the natural supply and demand? There's more demand for bonds. There's more demand than there's access to bonds. In Marty and Dan's data, it was 17 basis points. That's a lot. On a market of $450 billion in bonds, that's billions of dollars of mispricing. I don't know what the right answer is. I mean, it would be worth looking at how bonds break in the secondary in the corporate bond market. I don't think we have that data, or it's not easily accessible. Just to get a thumbnail comparison, are we doing things right? But that should be a big area of focus. That's literally billions of dollars of mispricing.
Brad?
I think it might be helpful for the audience if Marty or Dan, you just frame what that 17 basis points is. We've been looking at the data. Why don't you just set the stage, what we mean by that 17 basis points of mispricing?
Yeah, we're talking about the spread between the price that the issuer gets for the bonds and the price at which the bonds eventually land in the immediate trades in in the 30 days post-issuance. And so if you see an issuer getting $100, $100 for the bonds, and then a week later a customer buys it for 102, that's a 2% spread between what the issuer got and the price at which it was sold to the final customer. I will say, and pushing back a little bit on Colin, it's not 100% obvious that is a rent. Right, that rent in the sense of extraction of value by the underwriter community. That could be, and this is there's a nice paper by Paul Schultz at Notre Dame where he shows some evidence that's consistent with that markup reflecting the real cost of intermediation. Like it uses resources to break a bond issue in pieces and sell them to retail investors, and it takes some science to determine, okay, when is it excessive and when is it not excessive. And the other thing that Marty and I like, we're not, I'm perfectly capable of criticizing the underwriter community. Like I'm not sort of in bed with underwriters, but also it matters whether you look at the average bond or the average dollar of bond issuance. And I think the 17 basis points is the average bond. If you look at the average dollar of issuance, the larger issues you're seeing a smaller spread. And so the dollar total, you have to be careful. You have to be careful. Whether you're talking about the average bond, which matters. I mean, small issuers matter, but when you're thinking about the aggregate dollar totals, you have to be careful.
So I just wanted to make a comment on that. I don't think you can overestimate the effect of the loss of bond insurance, because what that did, at almost 60% of the new issue market at its peak, it was a different market in the sense that a small issuer could sell nationally if they had bond insurance. So they were able to take a small school district that might have priced completely differently absent bond insurance and sell it into a portfolio, a mutual fund that was AAA or whatever. So the friction that was created after that, I think, needs to be taken into account, and maybe that is an ongoing blip and does relate to large versus small dealers. Just a thought.
Brad, did you want to add to that?
The symmetry of the data is exactly what Natalie just said, where the spread was larger for the smaller issues, and that simply makes sense. But I agree with you. I think we could really argue both sides whether there's rents there.
Certainly also an issue that the regulators are looking at very closely. So I do want to try to get the audience involved. So if we have a question, I'll take back the gentleman in the back there. So I think we have a microphone coming by, if you could wait for that. Thank you.
Hi, Tom Metzold, retired former portfolio manager in the municipal bond market. And there's a simple calculation that nobody's doing. Let's just round up 17 basis points to 20 basis points and call it 2%. On $100,000, that's $2,000 that the buyer, the retail investor, buys one time, holds it to maturity, and pays a total of $2,000 until that bond matures and they reinvest. Supposedly, the institutions, of which I used to be one, and I'm arguing against the so-called model that it's better to go with managed money, if they take that same $100,000 and they have zero markup, they're getting it at 0%, but they're charging 50 basis points a year for 10 years, that's 5%. They've paid more and gotten less over the same 10-year period, and nobody talks about that. So, yeah, there's the cost of infrastructure, because the simple point is, with 1.3 million QSIPs, this is not the equity market or the corporate bond market. It's the simple cost of doing business, and it's actually better for the buy and hold investor.
So, Marty or Dan, do you want to comment on that? Do you have a...
I think that there's a lot of truth there. If you're looking at the total expense package that is paid by an investor, if they're investing through a mutual fund, that mutual fund might be transacting in large blocks, and so they're not paying, on the transactions that the fund is doing, they're not paying as much, but the investor is paying a management fee to the mutual fund. Now, I think a small number of investors actually invest directly without using a separately managed account. So in the flow of funds data, household, the bucket that's household, first of all, it's calculated as a residual, so we don't know exactly. But also, a lot of that money is separately managed account money, and so they are paying, there is some kind of fee is being paid, but understanding the total fee and expense structure that investors realize is an important topic.
I suppose that could be an interesting point for the DOL rule as well. What's really in the best interest, a ladder or manage money? Nancy?
Hi. I'm asking, I have a question and then a comment. Thank you. The question I have is with respect to the analysis that you referred to in the earlier part of your presentation, when you said that you tested for all characteristics of the bonds, did you separate credit quality? And because I would imagine there would be substantial difference in high-grade paper versus lower-grade paper, and that, the panelists have addressed it, particularly Natalie, with regard to speaking to the absence of bond insurance, but just the underlying large issuers with high credit ratings have very different costs of intermediation than small issuers.
Yep. So I'll answer that question honestly and somewhat nervously. We made like 100 tables for this presentation, and some we did and some we didn't, and I actually don't remember what went into this.
But, I would just say, I think it's significant.
I think it's important. One issue that we have with controlling for the credit quality, and I'll get into the weeds of the data a little bit. We also use data from S&P for the credit rating. If you're using the Mergent data, and I love Mergent, we use their data, but the thing they do that makes me filled with rage is that they, at the moment, their credit ratings are a point in time, today, right? So you might have you'd like to know the rating of the bond when it was issued, but in the Mergent database, if you go by the database, you have the rating as of today, which is not what you want if you're studying the primary market. And so we have the S&P data on ratings through 2014, and then we sort of carry forward the last rating in 2014. So we have those data. We've made tables with those data, and I'm totally blanking, or just to be honest, on what went into this presentation. But we'll share that with you.
Okay, thanks. And the comment I was going to make was I used to be a bond issuer, and before that I was a financial advisor at a big financial advisory firm who did this exact kind of analysis for clients before we advised them on the price they should expect for the sale of their bonds. And as an issuer, what I found was having that granular data and then telling the underwriter that we would evaluate the underwriter's performance based on the secondary market trading that occurred in the 30 days after the sale, and that underwriters who priced the bonds and put them away and had very smaller differences in price were rewarded with additional business.
I wanted to make just one comment about that previous question, and maybe Colin could touch on this a little bit, but that this total cost of ownership of a municipal bond from an investor standpoint, a retail investor standpoint, I've long been amazed that issuers haven't been more active in taking advantage of what's a de facto arbitrage there to go directly to the retail market and capture that 20 and save the 50 and issue directly to that market. And I know, Colin, you did some of that in issuing directly at the state of Mass, so maybe you could talk a little bit about that.
Yeah, we tried. It's not easy. So we had created a program, a 6-month program, where we sold bonds almost every day using an electronic trading platform, and really let the market determine how many bonds they wanted to buy. We weren't coming to the market with 100 million and trying to oversaturate the market. We let the market demand determine what we were selling every day. It was a way for us to normalize our prices. It was a way for us to normalize our spreads. It was a little bit like dollar cost averaging in the reverse direction. And the response was phenomenal. Individuals were still not buying directly from the state of Massachusetts. We were not a broker-dealer. So they were still using an advisor, but we were able to sell $6 million a day, every day for 6 months. and had a remarkable effect on our spreads. And it's not easy to get to retail. There's a lot of market conventions that make it difficult to sell to retail. Typically, when an issuer comes to market, there's a week's notice to the market. So by the time an individual hears about a bond sale, it could be too late, or they're not ready to sell. And then the sale date is typically 1 day, or maybe it's 2 days. You could be traveling. You can't get a hold of your broker. He's on vacation. All these things add up. It's easier to order a book on Amazon than it is to order a bond. So when we had this trading platform, we achieved straight-through processing. So if a bond was available to an investor, you would get a confirmation that same day that you were going to get that bond. That was groundbreaking. That took 6 months for us to develop. But Amazon developed it years ago, or whoever else. So there's a lot of things. There's a lot of work left to do in connecting retail directly to issuers. And I think it's a sort of unmined, untapped territory.
So this topic we're dealing with is huge. That's the good thing. The bad thing is we're short on time. So I'll take one more question if we have one. No more questions, so I'm going to let Dan have our final comment here.
The one thing for researchers to be aware of, I think the acquisition of Mergent, which all the folks doing research use by the LSC is going to be consequential for us. And I have detected, as I communicate with them, they seem very responsive to things that we're interested in, and they also seem very interested in charging us money. So, like my conversation with them about the point in time ratings, like the historical database on ratings. In the past, they with questions like that, they have seemed less interested. They seem very interested now, and they say, "Oh, yeah, we'll put that together, and we'll find a way to charge you more money for it." So the world is going to be different in terms of research. Whether that's better or worse is hard to say. It kind of depends on how big your research budget is. So,
if I could just make one final comment, the folks at Brookings are going to put up the 25 slides, and this group has had the good fortune of being able to analyze it for about the last 8 weeks. And due to my very scientific analysis, I figured out that 1 out of 7 attendees here is either from the MSRB or the SEC. So realizing that there's going to be full disclosure of same-day takedowns for essentially riskless principal trades, I think it's slide 24 or 25. Maybe you guys have it, but I've never seen it before. But it shows year by year the difference in essentially takedown between the institutional market and the retail market. It's just fascinating data that these guys have. And if you have it, I've never seen it before, but I would certainly take a look at those slides. For everyone out there, it was just great work on their part.
Yeah, and it is the intent of Dan and Marty to make their data available to folks that want to play around with it, and they're more than happy to look at collaborations with other academics that want to do some further research at some of those charts. Each chart could be its own research topic. So, well, I want to thank Dan and Marty for that great work that went into this presentation, and the rest of the panelists, and for everyone's attention. We have a 15-minute break, and then we move into our breakout session. So thank you very much.